Hello friends, welcome to Everyday Economics. My name is Avinash Agarwal. In this video, I'm going to discuss with you everything that has happened in 2023 so far as the Indian economy is concerned and so far as the global economy is concerned. We will be discussing about all the hopes, all the challenges that lie in our path as we enter into 2024. So the idea that we are going to discuss with you is basically captured over here. These are the key takeaways for this particular slide. If you want, you can make a short note of this, right? So when 2022 began, so it sort of started with a lot of reflation, right? There was basically a lot of money that was getting pumped into various economies, right? And those various economies were showing an uptick in their GDP growth rates, and the demand in those economies was increasing, coming back on track after pandemic, and things seems to be on track. But then the recession came along, or the recessionary headwinds came along, right? So yes, there was a rebound in the early parts of 2022, right? But now we are having, a lot of fears right now, right? Right now, what is happening is that we know that Vladimir Putin basically invaded Ukraine, right? And since then, the recovery hopes were dashed. Since then, all the optimism that the world was having regarding a fast economic growth with the pandemic receding, so that optimism sort of faded. And this war, this Russia Ukraine war, is another black swan moment. Black swan moment is something that nobody predicted. Black swan moment is something which nobody can control, and it usually has a lot of negative impact upon the economic scenarios of the world, right? So this black swan event is still something which is having an effect upon us, right? So the idea is that when we look ahead at 2023, we are expecting elevated food prices, right? And the idea is that we are expecting a lot of inflation in energy items, in food items, right? So this is the kind of situation that we are having right now as we are entering into 2023. Along with this problem, we are having a couple of other major issues. Like, for example, if you see the financial condition in various advanced economies, that's not very good. That's not very encouraging at all, right? If you also look at what's happening in China, right? So the Chinese situation right now is pretty grim. There is a new variant which is circulating in China, and a number of Chinese cities are facing a severe lockdown kind of a scenario, right? Apart from that, China is also slowing down as an economy, right? And like we discussed, there is high inflation, right? So to control that high inflation, central banks have been raising their interest rates across the world, across major economies of the world, and they're trying to slow the level of demand or reduce the level of demand. So there is this real good threat in front of us that we will basically plunge the economy into recession as we try to pull the prices down by pulling the level of demands down. Now, if you look at what's been happening in India, so yes, India did pretty well for itself in 2022, right? We have had a relatively strong growth performance, right? But the reality of life is that we were slowing down much before the pandemic, right? So India entered the pandemic after 8 successive quarters of declining growth and an increase in inflation. So even before the pandemic started, India was slowing down. That is the reality of India. So we are trying to still come out of that slowdown. We are trying to still come out of the pandemic induced slowdown. So even if we have had, let us say, a decent couple of quarters of, GDP growth, but that does not mean that the level of demand and the level of production in India is where it should have been or where it could have been. So the idea that we need to keep in mind is that the path ahead for India, it is a it is a steep one still, despite the fact that we may have had a couple of quarters of decent economic growth rate as compared to the rest of the world. Another thing that needs to be kept in mind is that India has been enjoying a favorable base effect because of the pandemic. See, if you compare what is happening right now with what was happening, let us say last year or the year before that. So last year and the year before that were, let us say, pandemic years, right? So those were the years where our production was low, where our demands were low, right? So if you are going to compare with a low base, right? So anything that you are having now will look good. The challenge in front of India is going to be that when you're comparing yourself with a low base, you look good. But next year, when you compare yourself with a normal base, you may not look that good. right? You may not look that good. That is the idea over here, right? This is the idea that you need to keep in mind, that when we are comparing ourselves with a low base, things may look okay, but going ahead, we need to really increase further up. We need to increase further up to have the same levels of growth rates that, or to have the high levels of growth rates that we may need. Now, if you look at India's growth forecast, which has been released by RBI, SBI, and various other financial institutions, so most of the pundits on the block are saying that there is a darkening global outlook and the emerging market economies are quite vulnerable despite whatever positive domestic indicators we may have been seeing. If we talk about the global growth, so we have managed to eke out a growth rate of 3% in 2022, and many believe that this is a commendable achievement given the fact that there were so many headwinds that were facing us, there were so many challenges that we were facing. To just give you a quick recap of the challenges that the world faced in 2022. So in the last 50 years, we have not had the kind of global inflation that we had in 2022. In the last 40 years, we have not had the kind of monetary policy tightening or the interest rate increase that we have had in the last year. In the last 20 years, we have not seen such a strong US dollar. In the last 45 years, we have not seen such a slow Chinese growth. Now, if you ask Sajid Chinoy of JP Morgan, so Sajid Chinoy will tell you that any two of these shocks, even two of these shocks, forget about all four, even two of these shocks would have been sufficient to turn the global economy into a recession. So you can imagine the kind of stress that our economies were facing, and keeping these stresses in mind, if we have been able to eke out a 3% positive growth rate, that is a commendable achievement. But the reality of the point is that we have been having a weakening economic profile, as has been explained over here. If you go by the IMF projections, right, so the growth rate of the world slowed from 6% to 3.2% and is expected to slow down to 2.7%. So this is the weakest profile since 2001, except for the global financial crisis years, maybe of 2008, 9, 10. Right, these are the weakest possible numbers that we can imagine. So you can understand the kind of stress that the global economy is facing. If we look at India's external situation, let us say, right, so of course there is global food prices, which is a worry, global energy prices, which is a worry, right, global commodity prices were a worry. They are moderating, yes, no doubt about that, but globally inflation is still quite high and it is still quite broad based. If you look at some of the numbers related to global inflation, so those numbers as per IMF were 8.8%, 6.5% and are expected to be 4.1% in 2024. Now, these high levels of inflation are pretty high when you're looking at an advanced economy. These numbers, right, let us say a 6.5 or a 4.1 may be okay for a country like India, developing country like India. But when you're looking at advanced economies, usually they have inflation numbers of approximately 2 or 3% or even lower than that. So they having 4.1, 6.5, etc., that is quite problematic, right? So the idea is that if, let us say, the inflation rate is high, prices are increasing at a much faster rate than we are comfortable with. So what will the US Central Bank or the US Federal Reserve do? They will jack up the interest rates, right? And why will they jack up the interest rate? Another reason is that the labor market in America is red hot. The hiring over there is at a very rapid clip, and the increase in wages that is being witnessed in America is at a pretty rapid clip right now. So the idea is that given the fact that the wages are increasing, naturally you can expect the prices to increase. Obviously the US Central Bank does not want this to happen, so it is going to increase the interest rate to control the inflation. So the idea is that the high wage growth of 6%, it is not desirable right now so far as US is concerned, because there the central bank is having a target of 2% for inflation. So the American Central Bank in all likelihood will continue raising the interest rates, and anybody who has studied fundamental basic economics knows that when you increase the interest rate, you increase the cost of money, and when you increase the cost of money, people will basically reduce, or they will not take as much loan as they were taking, they will not spend as much they were spending, so the demand should come down or will come down. Now, when there is an extended phase of rate hikes in the United States of America, what kind of an impact does it have, let us say, upon an emerging market economy such as in India? First is that our currency becomes less attractive so far as currency carry trade is concerned. So those who have studied finance at any reasonable level will probably know what is the meaning of currency carry trade. Those who have not studied may not be so bothered by it right now. Another impact upon India is that foreign investors may choose to not invest in India given the fact that they are getting decent amounts of returns by investing within America itself. Another idea is that the moment US central bank increases the interest rate, right? So the idea is that of course there may be an outflow of funds from India to US, but increasing interest rates in US will slow down the growth engine within United States of America itself. Coupled with the fact that China is slowing down, this is a very bad news for the global economy. Within the global economy, there are two major engines. There is a US and there is a China. They have pretty good levels of demand, pretty decent levels of demand. With China slowing down and with US likely to slow down, global economy is likely to face a lot of challenges, right? So that is precisely what we are saying, that when we are saying that there is a central bank engineered recession, right? What do I mean by a central bank engineered recession? It is the central banks who are increasing the interest rates to control prices, which will basically slow the demand down, slow their economies down, and plunge the world into a recession like scenario. Apart from that, there is a major challenge in front of a country like India. Normally what happens is that if commodity prices go up, dollar value decreases or dollar becomes cheaper, right? So that sort of cancels each other out so far as an importing country such as India is concerned. Please understand that if, let us say, commodities become expensive, let us say $1 becomes $2, the price of commodity, and let us say that dollar itself becomes cheaper, so both these things cancel each other out, and in an importing country like India is, it is beneficial for us, this kind of a scenario. But what is happening is that in the last 1 or 2 years, what we are seeing is that there is a strong dollar along with an elevated commodity prices. So what we are seeing is that commodity prices are going up. We pay for these commodity prices in dollar, and dollar is also becoming expensive. So we pay more for dollar and then we pay more for the commodity prices, right? So as a result of this, what is happening is that our import bill is becoming a headache for us. As you know that we are net importers of energy, net importers of commodity. So this is becoming a major headache for us. Now, if we do a quick, check of everything that is positive and everything that is negative for India. So we'll first make a list of everything that is positive. First positive that we need to keep in mind is that there are strong domestic drivers. If you look at various high frequency indicators, such as, let us say, your tax collections, and let us say your, what's happening in the equity market, what's happening in the transportation sector, what's happening in the, steel sector, etc. So various indicators are suggesting that there is a rebound. If you look at the car sales, etc., various indicators will suggest that there is a rebound. When you look at the consumer level inflation in India, you will see a moderation. You will see that food prices have been coming down recently in the last couple of months. If you look at more positive developments so far as India is concerned, so you will see that the twin balance sheet problem is basically getting rectified. What was the twin balance sheet problem? That corporates who had borrowed from banks, they were not doing very well in their businesses, and banks who had lent to corporates, right, they were also not doing very well in their business, in the sense that they were losing a lot of money in the form of non-performing assets. A lot of loans were getting stuck. So the idea is that corporates who had borrowed to invest, they were stuck. Banks who had lent, they were stuck, right? So both the balance sheets were basically having a lot of rotten apples on them. Both the balance sheets, that of corporates and that of banks, were on the weaker side. But of late, what has happened is that a lot of corporates have deleveraged, right? They have managed to bring their debt or the corporate debt to GDP has sort of reduced, which suggests that corporates have been able to jack up production and control their levels of debt, right? And the banks have shed much of the legacy bad loans, in the sense that banks have either been able to recover some amount of money via various these things, or they have probably written off the bad loans for the time being. Apart from that, there is an upturn in the capital expenditure cycle by the corporates. Why? Because their input cost pressure or the raw material cost pressure is declining. Their sales are showing a decent number, right? Apart from that, we also see that there is this PLI scheme right, which is offering an impetus to manufacturing, right? So although the larger companies are right now benefiting more from the PLI scheme, but be that as it may, there are fresh investments that are expected in India, at least so far as renewables, electric vehicles, and battery technology is concerned. So we are investing on the whole that the capital expenditure cycle by the corporates should be a positive thing for us. Bank credit has been growing, which is again a very good thing, because if people are borrowing money, they are eventually going to spend it, which is a good thing for us. There is a China plus one strategy which has been adopted by most multinational corporations. They believe that, if we are going out of China, then we need a low skill, unskilled, labor intensive manufacturing destination, right, where we can, let us say, produce textiles, shoes, leather, and ceramics. India has a very, very, very good positioning for itself when it comes to these industries. So India, yes, can attract a lot of investment from these corporations which are exiting from China. If you look at RBI data, so RBI data suggests that banks are lending term loans. Banks are lending term loans to non-corporates, which is a very positive sign. Non-corporates means, let us say, your micro, small, and medium enterprises. So if these fellows are taking on term loans, right, so that possibly indicates that they are taking money apart from their immediate working capital need. So probably they are going to invest in a factory, or probably they are going to invest in a production plant, right, because only and only then you will take a term loan, otherwise you will not take a term loan. So the fact that term loans are getting disbursed is a positive kind of a development. A robust tax collection has been witnessed at the central level. Deficits of states is something which is getting consolidated, is something which is coming under control, right? Their market borrowings are also coming down. So on the whole, these are considered to be positive developments so far as the fiscal policy is concerned. If you look at the agricultural sector, yes, the Rabi outlook is strong. Yes, the wheat production aspects look good. High support price is an incentive. Reservoir levels are pretty good. They will support irrigation, they will support agriculture, right? And all those things are pretty good so far as agriculture is concerned. Now, if I make a laundry list of all that is negative, yes, the Ukraine war is dragging along. There is a threat, right, that there may be an energy linked downturn in the European Union. Russia has been threatening everybody left, right, and center that they will stop exporting energy to all those countries who have implemented a price cap upon the Russian exports, let us say. So if Europe sees a slowdown, that is going to be a very bad news for India, because Europe is India's biggest export market. So if Europe does not consume as much as we want it to, then that's really a bad thing for us. Apart from that, there is inflationary pressure in US, rate hikes in US, and there is a possibility that the US growth will slow down. If you look at what the World Bank is talking about China, so the growth forecast for China is 2.7% this year from 4.3% estimated in June, and it has nearly half the projection of 8.1% next year. So World Bank has been reducing China's growth forecast for this year as well as for next year. With US and China both facing a slowdown like a scenario, there is mounting evidence that the global economy will slow sharply next year. Now there is a threat of higher protectionism worldwide, meaning that countries will impose some kind of import tariffs or import roadblocks, right? So there is this great fervor of deglobalization that can be witnessed across the world, right? Now the situation for us is pretty bad. See, China had a very decent period of growth rate, high growth rate for decades. That was a period of globalization, right? Countries were opening their borders up, countries were indulging in trade, countries were open to the idea of buying and selling to each other, etc., etc., right? Now India needs to be able to benefit from high growth. For that we need globalization, for that we need to be able to export. So given the fact that there is deglobalization, given the fact that there is protectionism wala mood that is taking root within major economies and policy making circles, right, that is not a very good thing for India, which wants to sell to the world and grow on the basis of those sales. If you look at India's own factory output, so our index of industrial production slumped to a 26-month low in the month of October, which is supposed to be a festive month. That's not very good, right? So there is a rapid downward revision of India's growth projections for the next fiscal as well. If you look at the breakup of the private consumption expenditure in India, there are worrying signs. So on the whole, the private consumption expenditure has been growing by 9%. but the idea is that who is spending. If you look at that, so then it is the upper income groups who are spending the most. Now these upper income fellows, if you ask Pranab Sen, who is former chief statistician of India, if you ask Pranab Sen that what do these upper income group fellows spend upon, so they spend upon a lot of imported items, right? They are not so interested in the domestic items as they are in the imported items. So if these fellows are spending much, then that means that India's import is likely to increase, and that is precisely what is happening in the last 6 months, that these upper income group fellows are spending and India's imports are rising. So it's not as if that, you know, consumption expenditure is being targeted towards, let us say, what is getting produced in India. It is being targeted at what is produced abroad, which is not going to help the Indian GDP or the Indian economy or the Indian manufacturing businesses. If you look at capacity utilization, which basically tells you that how much of your capacity you are using, let us say you can produce 100 units, how many units are you actually producing? So we are still hovering around 75% mark, that the capacity utilization is still 75%. So this needs to really go up, but it is not yet gone up, and that is something that we need to look out for. If you look at what has been happening in the MSME firms, right? So MSME firms are not doing very well. It is the bigger companies who have been able to rebound back from the pandemic, right? But the MSMEs are still struggling. If you need evidence, right? So we created this emergency credit line guarantee scheme for MSMEs. 1 in every 6 loans, that's approximately, let's say, 16 to 17% of the loans that have been handed out in these schemes have gone bad in just 27 months. And who is defaulting? It is your smaller MSMEs who have taken loans up to 20 lakhs are the ones that have defaulted. Now MSMEs are very important in India. Why? Because they employ a huge section of our labor force, right? And if they are continuing to face financial stress, there will be stress in the labor market. They will not be able to jack up employment, right? As a result of which, if the employment does not increase, incomes do not increase, therefore the demand will not come back on track. If you look at what the states have been doing so far as their capital expenditure is concerned, there is weakness over there, and this kind of a capital expenditure that states do is very important because it has a more or a better impact upon the economy as compared to, let us say, the capital expenditure of the central government. Another very important point which is negative for us is that we need to be able to manage inflation expectations. RBI needs to work upon that, right? So the idea is that already the RBI has increased the repo rate in India by 225 basis point, which is 2.25%, and they may increase it even further. So if this inflation expectation becomes unanchored or unhinged, and people start believing that prices will rise, then RBI will have no choice but to increase the interest rate to actually anchor that expectation of high inflation. And if you ask Michael Patra, who is deputy governor, so Michael Patra will tell you that there is a lot of revenge rebound in spending, that people who are coming out of lockdown, people who are coming out of, let us say, loss of jobs, loss of income, right, they are spending a lot of money, you know, just to sort of, you know, come back on track, get that feel again. And they are spending a lot of money on contact intensive services. They are spending on all these items, which is basically broadening the inflation in India. It is making inflation persistent in India. Another major challenge in front of us is that we are a hugely dependent economy so far as energy is concerned. We are dependent on import, right? So the idea is that when we import expensive energy, so that naturally puts a pressure on our balance of payment situation. It increases our current account deficits. So the idea is that if the dollar continues to strengthen in the next year, then that is going to be a headache for India, which we can do without. Apart from that, if you look at what is happening in the rural wages, so for the 9th consecutive month, there has been a declining trend, which indicates that there is a distress, there is an oversupply of labor in rural areas. Why? Because labor is probably not getting employed in other sectors, so they are basically creating a bulge in the rural area, right? And that is basically a very depressing kind of a scenario. All right, coupled with the fact that there is higher inflation in rural areas, right? So there is a lot of problem in our rural areas if rural wages are contracting consecutively. So this is the entire discussion. Hope you enjoyed it. Thank you very much. All the very best, and Jai Hind to all of you guys.